Hello, welcome to Mali Investment Talks. Joseph Areu, my name's your host. And remember, we have been talking in the last couple of episodes about the general do's and don'ts of investing in passive investment products. And today, I want to focus on treasury bonds. It's a major one that we spoke about. So remember, basically, a treasury bond is a loan. You are basically lending money to the government through the treasury. That's essentially what a treasury bond is. And in return, they give you call it a promissory notes, if you like. A promise to pay you back a certain face value after a given period of time, but also a promise to pay you every 6 months what we call a coupon. You can loosely call it interest. That's what a treasury bond is. So a treasury bond would give you high yields generally because they tend to be long term. And so the yields tend to be higher, which is good. Will give you good, reasonable liquidity. The bond market, even in our region, tends to be reasonably liquid. You can sell your bond pretty much anytime. Thirdly, a bond will give you good income. So you have secure income, something you can plan on, you can budget. Every 6 months you are expecting to be paid. And it gives you all that at very, very low risk. It's basically government risk, which is negligible. So that is what a treasury bond gives you. However, I would like you to just be careful about a few things when you buy a treasury bond. First one is, it's always best when you buy a bond to prepare to hold it to maturity. I would urge you not to buy a bond with a view of selling it off after a few years before maturity. Because if you do, and you can do so, but you're likely to incur some, what I would call a redemption cost. In other words, some sort of a discount on the face value. So if your bond, if the face value was 10 million, for example, if you sell it early, you're likely to get less than 10 million. Maybe not by much, depending on the market, but just be aware of that. So it's always best to hold it to maturity. First point you need to be aware of. Secondly, there are a number of things, a number of factors which again determine the price of a bond, or if you like, the risk of getting a discounted price and the risk of getting a lower price than the face value of your bond. First one is inflation. So if inflation is going up, if the inflation trajectory or the trend over time seems to be going up, then you can expect a risk of one day, if you have to sell that bond, getting less than the face value that you paid for. So be aware of that. Secondly, and related to that, is interest rates. If interest rates go up, if interest rates increase, again, the price or the value, especially if you sell your bond before maturity, the value of that bond will go down. The price will go down. There is an inverse relationship between the level of interest rates and the price at which you can sell your bond. So again, you need to be aware that's a risk factor. Related to that also is another risk factor, which is the length of the tenor, how long you hold this bond. The longer that tenor, the longer that period, the higher the risk that, one, interest rates might go up, and two, inflation might also go up. And as I've just told you, when any one of those two happen, then you are facing a risk of a discount in price of your bond if you happen to sell it before maturity. But even if you sold it at maturity, if inflation is so high at the time you sell it at maturity, well, it simply means that the purchasing power of your money will be very, very low. So again, you want to avoid very long tenors unless you really have to. If you ask for my advice, I'll be asking you, or I'll be urging you to look for maybe 5 years. If you really have to, 10, maybe not more, but it depends on your situation. Just understand that the longer the tenor, the more you are exposing yourself to a risk of a reduction in the value of your bond as a result of inflation, as a result of a rise in interest rates. The final risk that are related to bonds that I want you to be aware of is what we would call reinvestment risk. Suppose you wanted to reinvest the coupons that you get from your bond. Well, remember, bonds do not compound. That coupon is just sent straight to your account. It's up to you to reinvest it or to eat it up. So if you decided that you want to reinvest it, well, there's a possibility, there's a risk that you may fail to find an investment vehicle which gives you the same return or better that the bond was giving you. So in other words, you may not be able to compound the returns by yourself, even if you wanted to. So that is what we call the reinvestment risk. Of course, you cannot reinvest in the same bond. You'd have to reinvest in another instrument, and that could be a problem. So in summary, once again, bonds are good for income, good for liquidity, although that could come at a cost. Treasury bonds in particular, very low risk, but they are not maybe the best product that you might think of if you're looking for growth. So once again, thank you very much for listening to me. Do remember, as always, one, to subscribe so that you get subsequent updates to everything I talk about. But two, to get in touch, reach out to me using the contacts at the bottom of your screen if you want details about everything that I talk about. Thank you very much, and I look forward to talking to you again.